Welcome to BlackBull Markets from Auckland, New Zealand. Did you know 85% of retail traders lose money? 90% of new retail traders lose all of their money. The main reason behind this is because traders trade against the trend. The good old saying, the trend is your friend. In this video, we're going to discuss trend following strategies and how you could prevent yourself from losing money, but on the flip side, actually making money from trading. Let's dive into the video. Trend following strategies are very simple to implement on your chart for putting indicators on there to identify pivotal points where trends change, where you can identify a bullish or a bearish trend. Now, on the chart you see in front of you, this is a pound dollar chart, and I've inputted two moving averages. This blue line represents your 200-day moving average, and the red line represents your 50-day moving average. Now, it's a very simple setup I have here. Two moving averages, one chart. I'm using the 4-hour time frame. Now, I like to use the 4-hour time frame. It's used more of a confirmation time frame to me, going progressively upwards onto the higher time frames as we go on later on in this video. Now, if you are unaware of how to input the indicators, you simply go to Insert, Indicators. Now, Trend, which is a moving average, is a trending indicator. Hit Moving Average, and then you'll be able to input the period of moving average you would like to assess. In this video, I'm using 50 and 200. These are typically two moving average lines that we like to use to identify a trending market. Make sure you can see them on your chart. It always helps, especially where you're analyzing crossovers. Now, I want to start by talking about crossovers. These are key inflection points in the market where the two moving averages cross over each other to represent a change in trend. So what we can see here is the 200-day moving average crossing above the 50-day moving average, and actually having a pretty steep gradient there, which indicates the beginning of a move to the downside or a bearish trend. We've discussed in the past that a lot of traders who tend to go against the trend generally are at more risk of losing their money, whereas traders who follow trends generally do better than people who trade against them. So these moving average indicators really help you to, and also where you can look to enter and exit the market at. And using this as an example, we can see that the market had a crossover around the 26th of April. Now, this was when cable was trading at 140.813, and recently we've seen a pretty significant move to the downside. If we measure that top to bottom, that's around 854 points to the spot price presently. Now, you're asking yourself, okay, so how do I recognize this and how do I trade this? Well, if you're a long-term trader or a trader who maybe only places one trade every few months, you could look to spot these crossovers. Now, going back in time, we have the opposite happening here with the 50-day crossing the 200-day, signaling a bullish indicator. So what you may want to do is perhaps look to buy the market upon these crossovers and sell the market when it crosses over again. If you had done it on this occasion, buying around the crossover point here and selling it there, you would have made around 150 points between the periods of the 16th of March around to the 1st of May. So it's about a month and a half there. It's what some traders look to do. Other traders, however, look to use the moving average crossover points to identify a trend. Let me show you what I mean by that. So if I am now operating in around this this time zone here, considering this, all of the stuff past May hasn't happened yet, arguably you'd be a bull at this crossover here. You'd be looking to buy the market. Now the question is, where do I buy the market? Well, first thing to consider is, well, what is a moving average? A moving average is a lagged indicator. So it measures prices, historical prices, given a specific time frame. Now, a lot of traders use the moving averages as their guidelines for support and resistance also. So, for example, if we zoom in slightly onto this chart, we can see, take the crosshair, that the price operated between the two moving averages through here, and it bounced up off the 200-day moving average, which also was a former resistance turned support. So you've got a bit of a head and shoulders pattern forming there. Now, if you can see that it hadn't closed below the 200-day moving average on that 4-hour, on that 4-hour candle here, which is an indicator that you could have seen a further move to the upside, which we did. So if you had bought around there and used the moving average as your indicator for a buying signal in a bullish trend, perhaps taken 20, 30 points of that, you would have been in a good trade there. Now, if you have a look at that from bottom to top, that was around a 393-point move. So again, significant opportunities that you could try and spot. Now, you could see that there was a bit of confluence the next time it tested the 200-day moving average, and then it soon broke right through it. So at that stage, you're now hesitant in trading and perhaps risk off waiting for the moving averages to cross over again before you can look to place your next trade. And from a bull, you turn into a bear. You have a confirmation now of the 200-day moving average crossing above your 50-day moving average, which is a pretty solid indicator of a change of trend. Now what you can see is that your buys are now turning into sells. So your market is doing the opposite as to what was doing here, where you were buying low. Now you're looking to sell high. Selling high indicators could work exactly the same. So as you can see, the market is dropping below the 50-day here, and then continues to try and break the 50-day moving average to break higher. Doesn't quite make it, however, gets pretty close around this point here. It's around the 14th of June per se, where the price went up to 134.52, 51, and however, it doesn't quite break it. So that, again, for me, is a pretty strong indicator that, okay, we haven't broken the 200-day. I'm still pretty bearish over here. So if you placed a trade to short the market there, top to bottom, you're looking at a move of around 390 points. I know this is of course best case scenarios. The reality is you're not going to capture all of those pips. So if you have predetermined orders in the market that perhaps go conform with your profit-taking targets, you may only want 20 or 30 pips from that move, but the chances are you're putting the odds in your favor to really give a good shot at these trades. Now, if we take a live example, we're now coming into a more or less a pattern or a range between the two moving average indicators right now, which is pretty interesting. So I will now be looking for any price moves or any plays that look to breach this 200-day moving average, and that would be around, say, the 132.97 mark. So let me go ahead and move my indicator, my horizontal line, to the 132.79 mark. There we go. I mean, really, if we get, sorry, a bit higher than that, we're at 132.92. If we get a test of that level, and if the market does go and break it, I'm not going to be a seller in that market. I would probably stay off. But if it tests that level and bounces off of it,
it's a pretty good chance that the market will come back lower again. So I would be looking to place an order here to sell the market to preempt a move up to that price point, and perhaps maybe look to take 20 or 30 points from that trade with a pretty conservative stop loss. This is an example here of the pound dollar chart. Of course, this principle can be applied to several other FX crosses. It's a pretty effective rules. If we look at one on dollar CAD, for example, you've got a few core trending charts here. Again, you've seen a bullish pattern bouncing from that 200-day moving average, as you can see, and then moving to the upside. So look, opportunities are there in the market. It's just about finding the right ones. I've really gone through the cable chart there, and if you have any questions or want to discuss any specific markets, feel free to reach out to us. We'll be happy to discuss.
Thank you for watching this video. For more great videos like this, hit the subscribe button below, and good luck with your trading.